the threat of a recession has reared its head again after some data this week showed signs of a weaker economy. Treasury yields sank to a 7-month low as stocks also feel the pressure. Investors are now shifting their focus to Friday's jobs report for more clues on where the economy is headed. And Jared, of course, it's a solid reminder here, even as we think back to what Fed Chair Jay Powell had to say about the state of employment after the most recent decision from the Fed. They're still looking at a solid employment situation as of right now, and they're using that as one of their backstops in this dual mandate that they do have as they're continuing to fight hard against inflation right now.
That's right. And we're talking about the headline payrolls number this Friday. That's a big monthly jobs report. That's supposed to come down to about 235,000. But guess what? That is historically elevated. That is still a strong, robust jobs market. Now, what's catching my eye, a couple of things. Yesterday was a real turning point. We had 2 data points that came out. And then in addition to the jobless claims this morning, I want to point to the Wi-Fi Interactive, where I'm going to show you what's happening with S&P 500 futures right now. Now, we can see here at the 8:30 a.m. mark, kind of hard to see actually, we did get a little bit of movement there, but the net movement was down. And that is, we had a worse than expected jobs report and stock futures moved down. That's very similar to what happened yesterday at 8:30 a.m. as well as 10 a.m. Now yesterday, or 8:15 a.m. yesterday on that ADP number, that's private payrolls. We're talking about that as well. We got a downdraft there. And then at 10 a.m. for the ISM services that missed. So the bottom line is 3 reports in 2 days. Bad news equals bad news. Maybe people aren't concerned about the Fed, or maybe aren't thinking the Fed's going to pivot and all is going to be well. Maybe the economy and the stock market have to take a bigger hit given this rash of economic data. So I see that as a change here.
Yeah, and that's starting to show up in some of the commentary that we've gotten from CEOs, even JP Morgan's CEO, Jamie Dimon, of course, even as he had put out his annual shareholder letter earlier this week. One of the things that he'd said, yeah, here and now, as Luther Vandross would say, still good economy. But in front of us, storm clouds ahead. And one of the things that he pointed to is what the Fed may do and is going to continue to do, considering some of the economic data that you had laid out. And what they're looking for is a trend, is what Fed Chair Jay Powell and the rest of the FOMC committee is going to be tracking for. But in this near-term period of time, focusing on that abnormal quantitative tightening and spending particularly here, because that large quantitative tightening and other unknowns, reducing liquidity, triggering higher long-term interest rates, that is one of the near-term headwinds that CEOs are starting to wrap their minds around even more so right now, and how it may impact their business.
Exactly right. And we had this banking crisis unfold over the last month. It's a liquidity crisis at its core, not necessarily a credit-based one. And so QT, Jamie Dimon mentioned that 8 times in his letter. I think that's going to be a mantra for the coming months here.